episode 13. Lucky number 13, I am a sucker for horror movies. My favorite by far is The Exorcist, to the point that on our first family trip to DC, I insisted we spend like half a day in Georgetown by The Exorcist steps taking photos. The Toronto Maple Leafs have won 13 Stanley Cups. Who's the best hockey player to wear the number 13? I used to think it was Teemu Selanne, but after further thought, what about Matt Sundin? What about Pavel Datsyuk? Honestly, I think I give the crown to Sundin here because he really had no high-end line mates to play with most of his career. So while the answer to that may be uncertain, one thing we do know for sure is that Rafael Nadal has 13 French Open titles. Oh my goodness, Beyond MD, episode 13, here we go! Welcome everyone to episode 13 of the Beyond MD podcast. Today's topic is going to be part 1 of demystifying investment costs. So why do we talk about this? Well, you and I both know that any kind of investment usually incurs some sort of cost, and the cost can vary depending on what kind of investment instrument you are using. And you and I also both know that costs can eat into returns. So if I'm comparing two products and they're essentially apples to apples, then I'm going to be more inclined to pick the one that has a lower cost. But how can I do that? Only by informing myself of the various costs that come alongside that investment instrument. So today we're going to be starting off with mutual funds. And just to be clear, I don't personally invest in mutual funds myself, but I do consider them to be a fairly good starting point to begin to understand the various layers of costs that we can experience on our personal finance and investing journey. So my guest today is Leanne Mamchur from CIBC, and Leanne agreed with me that an entire hour-long episode dedicated to investing costs may be a bit much, may require some fuel, some caffeine. So we've decided to divide it up into two parts. So today is part 1, and then part 2 is going to focus more on ETFs, robo-advisors, and then some alternative proposals for cost structures in the financial industry. So today we'll be talking about things like the front-end load, the initial sales charge. So what will you be paying for upfront if you choose to invest inside a mutual fund? We're going to be tackling the MER, the management expense ratio, including its various components, and this includes often a trailer fee that goes to an advisor. And Leanne is going to help us understand today, if you are paying a trailer fee, if you are paying for advice, what exactly are you paying for and what should you expect to get in return? We're also going to be diving into the different series of mutual funds and touching on some of the key differences as it pertains to investment costs. We'll also be touching on the trading expense ratio, and then finally a discussion on some of the factors that will influence the management expense ratio and trading expense ratios. Now, it's important to mention that mutual funds can come with additional fees beyond what I've already mentioned. An example of this is the short-term trading fee. So what is this fee all about? Well, let's say if within a certain time period, let's say within the first 30 or 90 days, if you decide to sell or trade shares of that fund, then you can be subject to a fee. It could be 1 or 2%. The only way you're going to know if this applies to you is if you go through the prospectus of the mutual fund that you're investing in line by line. And I have to reiterate, it is very, very important to do this. Now, important to keep in mind, there have been some positive developments with mutual funds. So basically, spring of this year, the Ontario Securities Commission announced that they will be banning the deferred sales charge, which is the back-end load. So essentially, if you're selling a mutual fund, regardless of how long you have held it, you are no longer going to be charged a fee. And now Ontario joins the rest of Canada in making sure that this is a uniform rule. So my interview today is with Leanne Mamchur, who is a portfolio manager with CIBC Private Wealth, and she has over 19 years of experience in being an advocate for private clients. So after graduating with distinction with the Dr. Hugh Harries Medal in Business, which is awarded to the top grad of the U of A class, she continued her studies with the successful completion of the Certified Financial Planning, the CFP designation, the Financial Management Advisor designation, and also the Chartered Financial Analyst CFA Charter designation. Throughout her career, Leanne has held various roles, which includes personal banking, investment advisor, investment counselor, as well as her current and most satisfying role of portfolio manager. She's originally from Saskatchewan, but now calls Calgary home. She's married, an avid runner, and has 2 toddler daughters. And she is really, really passionate about demystifying cost in Canadian wealth management. So with that, here's my interview with Leanne Mamchur. Leanne, welcome to the podcast. Where does the podcast find you?
Thank you very much for having me. Actually, I'm I'm located downtown Calgary today in the Bow Tower. I have a couple of children at home, little ones, and they love me so much. They want to they want to spend so much time with me. So I find myself needing to be downtown.
Hey, Calgary, Alberta, my old stomping grounds. I did work there for 1 year, and you're in fact my third guest to come from Alberta. So I had two of my former colleagues on in episode 6, so always really happy to get the Alberta crew involved. And listen, leaving the house to get work done, that really resonates with me because I have two boys at home. I get nothing done at home, hence the reason I'm locked up in the basement right now recording this episode with you. So I totally get where you're coming from.
Yeah, and I just got my shot, so hopefully I'll be okay as far as protection wise.
Yeah, of course. Congratulations.
Thank you.
So, Leanne, we have some jargon to cover today, so let's just get right into it. And I know that the financial industry has evolved over time, and over several years, there was introduction of the client relationship model, so CRM2. I'm wondering if you can just kind of give us a brief overview of CRM2, what exactly it is, and kind of what positive changes it brought to the industry.
Yeah, for sure. I can certainly get into that. And I think that part of my motivation for kind of coming on and having this conversation is really about, I think that investors should have a good lens on what it is as far as costs and the breakdown and all of those things. And I think that CRM2 is a good start as far as like it started back in CRM, client relationship model. It's basically the industry's way of trying to get more disclosures and transparency in not only the cost structure, but also reporting and things like that. And it actually started over 20 years ago in 1995, believe it or not. And so then Glorianne Stromberg was the first person that kind of started talking about these areas and through her paper, which was entitled Recommendations for Regulating Investment Funds in Canada, that's what kind of jarred and created the Mutual Fund Dealers Association, or the MFDA in Canada. So that's kind of where it all started. And then, but there wasn't really a consumer appetite, honestly. And that's what it came down to, is that we were just in the midst of a bull market, and there wasn't that, you need the backing of some advocates, and consumers are the best advocates for sure, right, of financial services. And so then it kind of went away. And then January of 2004, that's where we got the next iteration. It was the fair dealings model. And that was really based on, the financial crisis. And so the bull market had gone, the tech crash and all of that took place, right? And so that was the next one. And that kind of piggybacked on her work. But it didn't really hit the mark, and it didn't really take hold either. And so after the last financial crisis in 2008, that's where they started kind of coming up, and they published this CRM or client relationship model. And so then we've had work being done in 2013, 14, 15, 16, and 16 implemented in 17 was the last. And that's what you're referring to here, is the CRM2, which is now 3 years, 4 years being implemented by the industry. And so in essence, it's about disclosure and being transparent for investors and to best efforts, right? And so I think still work needs to be done.
And so what are maybe a few positives that CRM2 has brought to the industry?
Yeah, and so the CRM2 does a great job of having some cost structures disclosed now on client statements in dollar format versus a percentage format, which for a lot of people, when you're seeing a percentage, they might seem quite low as far as what that percentage might look like, right? But then if you translate that into an actual dollar amount, that is a little bit more of a sticker shock, I would say, right? And so, but in essence, it's really what's disclosed right now is the advice cost. And so the cost, what you're paying for the advice piece. And so it's not necessarily for the underlying management or the operation of the institutional money manager. And so, and in addition, CRM2 did and I know this podcast is about cost, so I'll kind of focus there. But I know that also CRM two talked about performance reporting on client statements as well. So that's kind of like a side thing. But I know you're trying to focus on costs here, and so.
All right, maybe we can just start off by talking about some of these shareholder fees that people can incur when investing into mutual funds. So the first one I want to bring up is the front end load, or that initial sales charge that can happen when first investing into a fund. So what do we basically need to know, and how high can this fee get?
Yeah, for sure. And one of the things I should say is that it's been a little bit of time since I've had any sort of exposure to the like anything like the front end, because of course I and I guess it's not of course, but I do work with private clients and I really just use Series O and they don't have a front end associated with it. But in the industry itself, the front end can be something that is charged, and it can range anywhere, from 1 or 2%, 3%, all the way 6%. I think there's a regulation that it can't be above 8.5%, but that's really just through various research that I've done. It's just I'm very, very much removed from it.
No worries, because you actually already answered one of my other questions, which was going to be, do all series of mutual funds come with a front-end load? And so it sounds like the answer is no, because you're saying Series O does not. And Leanne, with regards to the back-end load, so the Ontario Securities Commission in the spring said that they're banning the back-end load. So is it safe to say that when one sells a mutual fund now that they are not going to experience a charge associated with that sale?
Yeah, I would say so. And so then about February, I think last year, is when they started, Ontario in particular, Ontario Securities Commission started coming out with that. And I think that it is effective June of 2022, whereby you will no longer see any sort of deferred sales charge, which was kind of like a penalty for getting out if you held it for a period of time in the retail mutual fund side as well.
All right, perfect. So it sounds like some good developments happening there. And now let's shift gears and maybe just talk about the MER, the management expense ratio. So I'm just going to ask you, Leanne, open-ended, like what is the MER and what are its various components?
Sure. And the MER stands for management expense ratio. And so it's really a percentage that you would find on the fund fact document that is what you are paying, or a component of what you are paying for the management of the mutual fund. And it can include various areas. And so in particular, I would say that the two main areas of the management expense ratio is the cost for advice in certain series that is included in there, as well as the underlying cost, which includes the investment management, so the institutional money management, as well as the operational costs, like keeping, producing statements, that type of thing, right, of the mutual fund. And so, but it really depends. The cost for advice, or what is termed as the trailer, it is only around in certain series. So you need to know what you are investing in.
Maybe we can just take a minute and dive a bit deeper into the trailer, because I do think there are people out there who don't fully understand this. So my questions essentially are, like, what services does this trailer encompass? And if you're going to be paying this fee, like, what exactly are you paying for? And let's say if I go to a mutual fund fact document and I see that MER at the top, I'm assuming the trailer is going to be embedded in that. So maybe you can just guide us through some of these topics.
Sure. And at times I would say, so the trailer, you could think of it as the cost for advice. And so in an A series, which is a type of mutual fund series, it may very well be included in the management expense ratio. Whereas an F series, which is usually tied to a fee-based account, tends not to, in fact, have a trailer. So the management expense ratio that you see listed is just the cost for the institutional and the operational costs of the mutual fund. And so the F class, though, it does still charge that overall fee. And so I guess I'll answer your question in terms of what is the cost of advice, whether it be a trailer or a fee associated with the cost. What are you getting for the if you're paying for advice, right? As far as that goes. And so, and I think I would break it down into kind of 5 areas. And I know that sounds lengthy, but I would say that the cost of advice would very much be on the coaching on the behavioral side. And so as an investor, it's very emotional when the markets are going haywire. And it's also emotional when the markets are going really, really well. And so you might, as an investor, make decisions based on just human nature. And I would say that even between spouses, I've seen or been part of whereby a spouse will be quite angry with another spouse in relation to something behaviorally, right? And so then, because they made choices in investments. And so I think that the behavioral coaching is part of that advice for sure. And the overall guidance to prevent you from making wrong, natural human tendency moves, I suppose, during wrong times. But over and above the behavioral side, I would say that there's also the financial planning side. So creating regular reviews of your goals and best efforts. It's not really more like, I know that there's planning softwares and that type of thing that you can just punch away the numbers at. But I would say that the advice piece would be more so along the conversation that it creates with your advisor, as well as like the nuances and how the why behind things and the change that it happens over time to your plan and how you change your assumptions. Everything is changing. It's a constant state of flux, right? So kind of, and to best intentions, I would say, is that people intend to update their financial plan and then it goes by the wayside because it's just, one of those things that individuals, but if you have an appointment with your advisor, and you're doing that jointly, I would say you get that done. So that's the second component. I know there's 5, so I'll be quick on the other 3. And so I would say from the financial planning, you get things like structuring the types of accounts. And so whether you should have an RSP, a TFSA, an IPP, like an individual pension plan or a retirement compensation arrangement, all of those types of structuring, including things like that you might not think of, like family trusts and family foundations and various trusts, whether it be testamentary or inter vivos, all of that type of structuring can, from the financial planning conversation, then you get into all the different account types and that type of thing. And then from there, I guess you get to the mix or the asset allocation. And so your advisor really should be talking about what mix you should have overall to get to all of your goals. And so maybe you're retiring in 10 years or 15 years or what have you, or you want to fund your children's education. How do you get there? And what kind of mix do you need in order to get there? And then finally, the 5th one, I know this is a long answer.
No, this is good. This is good.
But the 5th one is really the placement and tax orientation of your accounts. So you might have all of these account structures, but where should you hold your Canadian equity? Where should you hold your international or emerging? And where should you hold fixed income? It's not going to be universal amongst all of your accounts. So I guess the advice that you pay for is all of those things. I don't know. It's a lot.
Okay, there's a lot of useful information there. And Leanne, I really like how you started off with behavioral coaching because I really feel like I could have used some of this, especially in March 2020 when the markets were tanking. Because I remember logging into my Wealthsimple Trade app and I saw my TFSA plummet. And I think it fell as low as 50%. And that's because I held a lot of Canadian small cap stocks. And the good thing I did was I didn't sell. But looking back, I probably should have bought more than I did. And in terms of one spouse irritating the other, like this happens at my house all the time because I remember I would make purchases, I would buy stocks, and then things would plummet more. And then I would run to my wife and say like, oh my God, I mistimed this again. And she would just be like, get over yourself. It's the markets. Like you're driving me crazy. Just stop talking to me about this. So I get it. Behavioral coaching, I think that goes a long way. And I think it really applies to everybody at some point in their investing journey. So let's take a minute and just look at where things stand today. So let's say you're investing in mutual funds and you have an advisor. Like what portions of the fees, what portions of the MER, maybe it's all of it, but what does the advisor have to disclose today in terms of fees as things stand?
Yeah, and so absolutely 100% of the costs is obligated the advisor needs to disclose that. And so that is what I'm referring to on the fund facts sheet, right? And so prior to a purchase, the fund facts discloses a number of other areas too, including objectives, the costs, the overall mix, the risk profile, past performance, what rights you have as an investor, but it does include the cost components. So on the onset, an advisor will be disclosing the full gamut and have full transparency. Having said that, I do feel as though that in that meeting, you're talking about a huge gamut of things. And it's hard for an individual investor to take that fund facts that they've received and really comprehend it, I suppose, right? And not even comprehend. Comprehend's not the right word because of, yes, if you read it and you would comprehend it, but it's more so, you've just talked about so many different things. This is kind of a side thing. You're probably just going to shred it or throw it in the garbage and not look at it. Having said that, it is technically disclosed fully.
So I know that mutual funds can get complicated, and I know there are many series, many iterations, but perhaps, Leanne, can you just go into a little bit of detail into the different series of mutual funds and maybe highlight what we need to know when it comes to MER and cost as it pertains to these different series? Like, what are the basic things that we need to understand?
Yeah, sure. And this is where it gets very complicated. And I think the industry has done their best efforts as they've continued to create a whole bunch of different series. They're all serving different purposes and different types of clients, I suppose, right? And that's why we have so many different series. But in essence, it's like adding on and adding on and adding on. And then you have this huge, quite confusing area. And to make the problem is a little bit more extensive because it's also to do with the different firms. So the different firms might have different labels to these series. So that's kind of the background before I kind of get into like highlighting a couple of the different series. So I guess I might highlight Series A, Series D, Series F, and Series O. And I know that sounds like a lot of alphabets already, but
the alphabet soup, right?
Yeah. And I might do it in the way of what typical client would look at this type of a series, perhaps. And so starting off with Series A. Now, myself, I run a private practice and deal with private clients, and so I don't really typically use a lot of these mutual funds. I do private pools myself, and that's Series O. And so, but Series A, it's more so for a client on the retail side that potentially might be working with an advisor. And so you could think of A like advisor, right? And so if you're going to, think about it like that. And so with Series A, you might have a management expense ratio, the cost, that would include the underlying institutional money management as well as the price for, or the trailer, which is the price for that advice, right? And so that would be the retail side. So you'd have both components. The next one would be Series D, and you could think of that one as for discount brokers, like discount brokerage clients, right? So people who want to do it on their own, they kind of factor in the cost of their own time and have the bandwidth, have the passion, that type of thing to do it on their own. And so then, and they don't need the advice or don't feel as though that they need the advice. And so then Series D does not have the advice component, right? And so it has the other component, but not the advice component. That's kind of how you...
All right. So no trailer associated with that then, right?
Right. Yeah. To my knowledge, like there's, as I said, it's kind of an industry that's kind of created a lot of, differences. And then turning to Series F. And so Series F likewise does not have an advice cost associated with it, but it is typically used in accounts which has a fee overlay. So you're still paying for that advice component, but it's not part of the management expense ratio, if that makes sense.
That makes sense.
Yeah. Okay. Yeah. And so, but it's again, specifically and typically more so on the brokerage side and that type of variety might be using the Series F or for those clients. And then finally, Series O, which is the private pool arena, that's the type of series that I would use. It includes the costs. Like, it doesn't really have a management expense ratio associated with it, or a very, very low, because the full cost is charged directly to the account for both the underlying money management as well as the cost of advice. So you can fully transparently see it on your statement. And so with Series O, you're paying for both components, but it's just it's fully disclosed on your statement. And then also it's reserved for, typically private clients or what have you. So you need to have an avenue to get access to it, I suppose.
Okay, so for Series O then, it's full disclosure of all costs in dollar figures on the statement?
In dollar, yeah, it's in dollar figures. Now, the only part, and I would say for my clientele, when I quote a cost structure, I quote the all-in cost structure, including, and I know we haven't quite touched on it yet, the trading expense ratio, right? And so then the trading expense ratio is the only thing in the Series O that is not on statement, right? And so you have to be aware of that. And so it's typically, so when I quote a price, it will include the trading expense ratio. And then when it comes to billing, their billing will be lower because the trading expense ratio is embedded.
Okay, just a little bit more on the MER before we move on. So let's say if you have two funds and one fund invests in foreign equity and the other in domestic equity, will the fund in foreign equity tend to have a higher MER? Like, is that a rough generalization?
Yeah, I would say that the MER is a direct reflection as to the cost of the management, right? And so for fixed income, you might see a little bit lower in the way of MER, but for foreign equity, especially emerging markets, you would see a higher management expense ratio related to that. And that has to do with a number of different factors, including the complexity of exchanges, the complexity of dealing in foreign currencies, and also, if you can imagine, the portfolio manager, the underlying institutional portfolio manager, needs to do a whole bunch of traveling around and meeting CEOs and things like that of a number of different countries. So that does add to the cost structure for sure.
Okay, so let's say you're investing into mutual funds in Canada, and I think I have some hunch as to what the answer might be, but I just want to get a sense of how do the costs here in Canada, like with the MER, compare to, let's say, the United States or maybe other countries in the world when investing into mutual funds? Like, where do we stand right now?
Yeah, and I by no means am an expert in kind of like the broader. I've just worked here in Canada, and so, but having said that, I have done a lot of reading in this area because I'm, part of it is, yes, I am including for your listeners an article, but I'm also working on a book. So I am doing kind of some research on my own, and the book is not all about cost because that would make for a very boring book anyways, but it's just one component that I am doing a little bit of research on. And so, but in my readings, it does feel as though that the Canadian investor, it's on the higher end comparatively to internationally, and around the world, these types of changes in disclosures are taking place and have kind of started in and around the same area. And so I think that over time, we're going to see it evolving and changing, as we've already seen here. Yeah. And so, but I can't really specifically give you statistics or anything like that.
Hey, no worries at all. I think as long as we have some rough trends in mind, that should suffice. So let's shift gears now and talk about the TER, the trading expense ratio, the metric that not many people seem to talk about, including myself. So what is the trading expense ratio, and kind of what do we need to know about?
Yeah. And so the trading expense ratio, it, includes the actual trading. And so then like the cost of buying and selling, that sort of thing, right? And so that is an extra cost over and above the management expense ratio. So those are two additive costs together. And you're right, not a lot of people are aware, especially it is, so I should back up, it is on the fun facts sheet. And so it is like right on page 2 at the very bottom, you can find the trading expense ratio if you're looking for it. But again, you're right. As far as knowledge, people don't know that it exists. So thereby they don't think to look for it. And I can say that, like, I've been licensed in all different areas, like the mutual fund side, IROC side, as well as on the investment counseling side. And I have done full disclosure, but it always surprises me as far as what clients hear versus what they necessarily remember 5 years after, and that's where it comes down to it, right? And so the trading expense ratio is just not something that people remember or aren't aware of, right? But definitely is additive to your costs, for sure.
All right. And can you maybe give us a brief overview on some of the factors that might influence the trading expense ratio?
Well, and I think that it depends as to what kind of trading activity is done in the particular market, also volumes, how liquid the market is and that type of thing. And so that all impacts the cost of trading and also, frankly, the size of the institutional money manager and what pricing and that sort of thing that they're able to have, because like sometimes when you're trading in bigger dollar amounts, then you have better execution costs, right? So it's all about the execution costs.
Okay, and what if one is investing into a mutual fund that is more focused on bonds? I know bonds don't get too much attention these days, but I mean, they still have a role. So would a fund that's focused more on bonds have a TER or not so much?
And so typically not so much. And so then bonds trade on spreads typically. And so there would be less, if any, in the way of trading expense ratio for a fixed income. But it depends, because if you get into emerging market bonds or things like that, then you can see some trading expense ratios associated with those.
Got it. So what we kind of know about the TER is that it's additive to the MER, and it's something that's not as frequently discussed. So what I'm wondering, Leanne, is at the end of the year, how is the TER kind of revealed on a statement? Is it something that's just basically subtracted from the net value of the portfolio? How is it revealed?
Yeah, and so that's where I think there's subsequent papers to some of the disclosures that have already been taking place in Canada, but this is one area that I think that we will have to move towards. And so then right now, as it stands, the trading expense ratio does not appear on statements. And so typically it's just deducted directly from your investment. It's embedded is how I would say it. And so you're not going to see that on a particular statement. So with my clients, as an example, I would have during their annual reviews, I would have a separate cost structure reminding them and quoting them the total cost and the TERs on there for me. And a lot of other portfolio managers are taking a similar route as far as disclosure, but it is not currently on the statement, no.
Okay, that's interesting. I did not know that. Now, in terms of the MER, the management expense ratio, that's a term that we tend to talk more about and we are more familiar with. So I think most of us have an understanding of how large or small the MER can be. And I know we're going to talk about ETFs in the next episode, but for an ETF, for example, the MER typically goes anywhere from 0.05% all the way to maybe 0.7, 0.8%. And I know the TER is going to be less than the MER, but perhaps you can just shed some light on the magnitude of the TER. Like, what are we typically going to expect to see here?
Yeah, and it could be like a broad US market. It could be some as low as 0.03 or 0.02 or something like that. And then it could range all the way up to like 0.26 or something like that for an emerging market. So I would say on average, when you're looking at a balanced portfolio, you're looking at an additive amount of, let's say 10 base, like, or 0.1%, right? And so it's not a huge addition, but it's something that certainly I think awareness should be had.
Absolutely.
Yeah, exactly. As far as full disclosure.
Hey, Leanne, I think that's a really good overview on basic investment costs that we can experience, especially when investing into mutual funds. And I think that's going to set the tone for subsequent topics. And one of the reasons I wanted to have you on here is that I know for myself and for many others, at various points in the investment journey, I think that costs can be somewhat confusing and somewhat convoluted. And I think it's an area where if we really just take the time to inform ourselves, I think that knowledge can go a long, long way. So I just want to thank you for taking the time to be with us today and sharing your expertise and your insights. Really, really helpful.
You're very welcome. I'm grateful for the opportunity to kind of come on, because I do think with knowledge comes power, as far as like the more your listeners are informed as to the different areas, then they can use that, right? And so, but no, I really appreciate you doing this podcast. It's good.
Oh, it's my pleasure. Thanks again, Leanne. Take care. All right, that is part 1 on investment costs. I hope that was useful, and we'll come out with part 2 pretty shortly. Again, I just want to thank everyone for the support, for tuning in, and everyone for leaving the ratings and reviews for the podcast. Trust me, I greatly appreciate it. Now, if you want to get a hold of me, fastest way is always LinkedIn. You can message me there or email me at beyondmbpodcast@gmail.com. So if you guys like what you're hearing, feel free to download, subscribe, and spread the word. And until next time, keep well and stay savvy.